There we go.
Good evening.
Live on a Monday night, and just like that, Mike has arrived from holiday.
Good timing.
I'm back.
That was that. If we couldn't have timed that any better, I don't think actually
Nailed it.
could not have timed it any better. So this evening, while people are realising we're live, the notifications have just gone off on my phone, so people get an idea. It's Monday night. There's been a lot going on last week. So Ellen, Chris, Mike have jumped on StreamYard live with me, and we've got a special guest in as well, Thomas Brown from Partners Financial Services, who is going to give us, hopefully, as a mortgage broker, a little bit of an inside bit of information to what the banks are doing today, what products are available, if there's been big changes in the market, and can anyone get a mortgage? Because last week that was a bit of a challenge. So I'll come to Tom in just a second as people find out that we've gone live. If you are joining us, it would be amazing if you could pop a like so that you know, so that we know you can hear us okay. We're on LinkedIn, we're on Facebook, and obviously we're on YouTube. Ellen, going to come to you first. You had a good Monday?
Always. Monday's always good. Yeah. Kickstarts the week, back of the weekend.
People viewing houses, people offering on houses, and people putting houses on market.
Yeah, all of the above. Been a crazy sort of last week was all a little bit, people didn't know what was going on. And there was a lot of panicked phone calls, but we all, enough reassurance, everyone's fine. Everything will be fine.
Good. Okay. Well, we'll come more onto that point shortly. I'm going to go to Chris next. Chris, I'm not sure whether you're about to start hitting me with some lyrical flows with the big microphone that you've got there.
I can beatbox if you like.
Or just DJ. I don't know, something like that. But yeah, looking good, Chris. How's the Surrey market been over the last week?
It's, I think, much the same as everyone else. You know, it's good. It's frustrating. It's busy. I think the biggest issue I think I've seen over the past few days is transactions that are transacting, is people's panic that they're going to lose their mortgage offer. You know, if they're not going to get it through in time, they can't get an extension. That's the issues I'm experiencing at the moment. You know, it's not been a mass exodus on the pipeline of sales that are going through. You know, there's been the odd casualty, as there always is, regardless of the market. But good. But I think there's just a lot of uncertainty still kicking around, as there is in everyone's areas at the moment.
Yeah. Okay. Well, hopefully we can give some people, I guess, a little bit of reassurance or a little bit of panic, depending on which direction it goes, but what's actually happening at the moment. I think we've got to go to Mike and say happy birthday, Mike, for Friday.
Happy birthday.
Happy birthday.
You had a good one on the beach, I believe.
I did what I could, yeah, to keep the Greek economy going, you know, whilst I was there. Hopefully, well, a few euros were spent and a good time was had by all. Yeah, thank you very much.
Yeah, Mike put a WhatsApp to the government, dropped the bomb and went straight abroad. And the whole country exploded, and it's just coming back to normality as he's landed, actually. So, yeah.
Things fall apart when I go away. What can I say? People need me.
Tom, coming to you. Thanks for joining us on this live.
Pleasure.
As it says in the banner just there, you are a mortgage advisor. That is correct, I believe.
That is correct. Confirmed.
Yeah, quite a few years in the game, over a decade now, I believe. And what a week, you said, as we joined. What a week.
Yeah, what a week. Like you said, 11 years. And in that time, I can't remember ever a more stressful week, a crazier week, and having so many phone calls and emails from everyone at every stage in their journey. So people were concerned when they just started looking. People were concerned when they had an offer accepted. People were concerned when they were getting to the end of their transaction, getting close to exchange and completion, that their mortgage offer was going to be pulled. You know, almost every single person that I had on my book was reaching out to me to say, you know, what the hell was going on? And it sounds like it was reflected with you guys as well. So mortgage offers, I think that was a point that you've all raised. Mortgage offers haven't been withdrawn, and I think it's safe to say that won't be withdrawn. I think the general consensus is that if you've got a mortgage offer, that your rate and your mortgage offer will be honoured. So a lot of people are sitting on mortgage rates from 3, 4, 5 months ago that look a completely different picture to how they look now. It's unbelievable to say that people have got mortgage rates that start with a 2 and a 3 that are suddenly going to be very, very happy with where they are.
Yeah.
In terms of mortgage rates for new applications, most lenders are lending. There was when mortgages makes the BBC breaking news headline, it's pretty serious.
Yeah.
And I was reading last week that a lot of lenders withdrew their deals completely, and some lenders are still have a list of no products, but that's mainly the smaller regional building societies. So you'll find that the smaller regional building societies are a lot more cautious, and some of those who withdrew their rates, mostly you wouldn't have heard of. And it's probably not going to have a major impact on your mortgage application because you're very, very unlikely to go through them. The main high street lenders are pretty much all back to where they were, with a few exceptions. Santander have got a heavily reduced product list. So they've, I think, only got products at 2 loan to value categories, I think, rather than the usual 60%, 75%, 80%, 85%, etc. So they've got a far reduced list. Nationwide are lending as usual. I sent you a product guide, actually, Ian. I don't know whether it's possible for you to bring that up. For Nationwide, it was correct as of last week.
You don't just want me, do you? Can you bring that up? There's Ian's face. Brilliant. Let me
We'll get there. It's okay, but that shows where rates are at the moment. There you go. If we can see that. So no rates that are fixed that don't start with a 5 or a 6. So 5-year rates lower than 2-year rates, which has been the case for the majority of this year, actually. And 10-year fixed rates lower than 5-year fixed rates, which is bonkers, frankly. So that hopefully gives an idea about when all lenders are returning to publishing products. Nationwide tend to be there or thereabouts in terms of their pricing. So hopefully that gives a rough guide of the rates and what things are going to look like for how long. I guess nobody knows, because last week there were lenders releasing products at 10 o'clock and withdrawing them at 4 o'clock. I've never seen anything like that ever before.
That is crazy, isn't it, Tom? That this was going on, and I did hear. I know you said no offers were retracted. I did hear, be it rumours, that a lot of mortgage offers last week were getting pulled. Even heard that one lender had pulled something after exchange, which I don't know if that was just wildfire craziness. But
yeah, I mean, look, a mortgage lender has always got the right to withdraw the offer at any time. It doesn't have anything have to happen for them to do that. They're perfectly within their rights to do that. Never in my 10, 11 years has that happened on a case of mine or to a client of mine, but they're perfectly within their right to do that. Mm-hmm. As far as I know, and as far as I would expect to happen, no mortgage offers should be withdrawn for an application that's already gone in or an offer that's already been agreed. The BBC and the Daily Mail, in particular, believe it or not, were thrown a few misleading articles about mortgage offers being withdrawn. Actually, they were referring to the lender's mortgage offers for new customers rather than actually mortgage offers as you or I know them as mortgage offer documents. So I don't know whether that was maybe a little bit of confused lingo or whether that was just a bit of conscious, we're going to put this out and it could be misinterpreted. But that was, when I read those articles, the fact that offers were being withdrawn, like the rates you see on the screen. You want to make an application, this is the offer we'll give you. Yeah. Rather than you've already applied, here's your mortgage offer, as we know it to be an official document.
What sort of percentage of the market of products do you think is back as of today in comparison to kind of 3 or 4 weeks ago? Roughly, I won't hold you to it because we're never going to find out. But
I think that the smaller regional building societies make up more products than people realise, given the fact that their maybe lists are down to a very minimal list, if not zero. I would say maybe 60 or 70%. However, if you look at the mainstream lenders, and let's face it, the lenders that you're actually realistic or likely to use for your mortgage application, we're probably closer to 80 or 85%. Skipton, one of the big names, they were one of the first lenders to withdraw all of their products. I think, what day was it last week? Monday night or Tuesday night?
Tuesday,
One of the first lenders to completely withdraw. They've just announced that they're back as of tomorrow. Accord, who are the broker arm of Yorkshire Building Society, they're not back yet. They're one of the ones that are still no products whatsoever. So in terms of the mainstream lenders, we're probably back to 80 or 85%. As I said, the only high street lender I can think of that has got a really, really heavily reduced product list is Santander.
Okay.
And obviously Halifax with their fee products. That was a big one as well.
Tom, that's good information there. And I know Chris is thinking about buying a property soon. And as you kind of look at that,
not.
or not, as the case may be, I'm good at giving secrets away about Chris's life on these
You
lines.
really are, yeah. Well, next you'll tell everyone I'm having a baby.
No, I never said that.
We are, though.
But if you were looking at that rate card, Chris, and you're a first-time buyer, it'd be very easy to get eye level drawn into those tracker rates. Looking at them, you know, if you paid the fee, for example, on that top one, you'd be looking at something like 319, or as a first-time buyer, 329. It'd be easy to take what I would define as a little bit of a gamble on those. What do you think, Chris, as you sort of look at that rate card? It's obviously a little bit scary, but
yeah, I mean, I think, yeah, from my perspective, yeah, I'm not a first time buyer anymore. But if I was, you know, without knowing what I know about things, then yeah, of course, you know, in a perhaps slightly naive way, you know, you'd think, okay, well, yeah, sort of, I'll take a gamble. That said, you know, we know which way the rates are going, and you know, it's not something that would clearly interest me now. Obviously, yes, we are looking at moving again, you know, starting the process ourselves, you know, next month. But are we going to do it? I don't know. We'll see what comes out the other end once we've gone through our new application process. But I mean, no, I'm certainly not tempted by a tracker at this point. And yeah, unless, you know, Tom, you can say anything which actually means that actually maybe you should. Yeah, but then no one's got a crystal ball. If we did, then well, we'd all be doing this broadcast from our yachts, wouldn't we? But
Tom, do you want to just explain for people that are watching or listening exactly the difference between the tracker and the fixed, just in layman's terms, just to be clear?
Yeah, sure. So fixed rate will be that your rate is set for a predeterminate amount of time. So you can see there across the top will be 2 years, 3 years, 5 years, or 10 years. You will say at the outset how long you would like your fixed rate to be for. And then that's the rate and the monthly payment that your mortgage will be for that amount of years. So you can essentially fix in for a monthly payment for a set amount of time where you know what your monthly payments are going to be going forward. A tracker will be a rate where your rate can go up and down depending on market conditions. So generally, mortgage lenders' rates will track the Bank of England base rate, and it will be a certain percentage above the Bank of England base rate. And as the Bank of England base rate goes up or less likely down, your rate will change depending on what the Bank of England base rate is at the time. So yes, that top rate of 3.19% for a tracker looks very attractive. However, if the Bank of England base rate increases by 1%, for example, that's going to go up to 4.19, and further increases are going to push that rate higher and higher. Just a point I'd actually like to make on the trackers is, you know, like you said, signing up for a tracker looks attractive. If you look at the top row, 3.19 versus 5.89. So 2.7%, the difference between a fixed rate and a tracker. If you think I'm going to take the tracker rate, and then if rates do go up, I'm going to fix in. If rates do go up by 1 or 2%, those fixed rates aren't going to be 5.89. They're going to be 7.89. So the fixed rates are always going to be a certain point above the tracker rates, because with a fixed rate, you're buying the security. You're taking the longer you fix in, you're taking a bet with the mortgage lender to say, I think rates are going to stay this low for this length of time. And generally, not the case at the moment, but generally, the longer you fix for, the higher the rate, because you're buying the security. But actually, it's so interesting that at the moment, and for the course of the whole year, the longer term fixed rates have been cheaper than the shorter term fixed rates. So it really, really makes sense to to look at doing a longer term fixed rate, presuming it is your home for the long term going forward.
Yeah. Okay. I mean, I'm looking at those, and the only thing that, if I was a gambling man, and I'm not, but if I was, the only one that looks semi-appealing to me on the tracker front is probably that first-time buyer 90% loan to value tracker at 3.74 with obviously the fee, just because if you look at the difference of the fixed rate on that at say 6%, will we see 2.25% increase on the base? I don't know. And if we do, it's level. So will we see over that? Will we see 2.5%, 3% uplift on the base? I don't know. That's the only one that I can sit there and look at and think, you know what, actually with a 90% loan to value, 10% deposit, I might be gambling on that. What do you reckon, Mike? You're a shrewd man when it comes to planning. I can see you attentively looking at that rate card.
I'm potentially a gambling man. I'm not a financial advisor, first and foremost, but on those rates, I'm potentially a gambling man to save my money now. Pay as if I'm paying 6%, but on a 3.54% rate, potentially is the better deal at the moment. But I'm fortunate, well, halfway fortunate to be fixed at 3.5 at the moment on my own personal mortgage. My outlook on life is to actually pay my mortgage as if it's more like 5.5%, because when that rate ends, I'll have a much smaller debt to refinance onto. That's my kind of Martin Lewis tip of the week, is if you're on a better rate than what that card says, maybe try adjusting your finances to pay it as if you are on that high rate. So when you do come to remortgage, you won't get the shock of a lifetime that you suddenly have to find another £300-400 a month. The rate will the repayment will actually come down because you've overpaid so much interest over that 2 or 3 year period. So I'm sure Martin Lewis will be telling people that if you're on a really, really rocking good interest rate at the moment, start overpaying for the future.
Is he a good advisor or not, Tom? What would you say there?
So overpaying has been my biggest piece of mortgage advice that I've given probably for the last 10, 11 years. About if you've got a spare 10, 15 minutes and you really don't know what to do with it, then a mortgage overpayment calculator online can show a massive, massive difference. Even what overpayments of £100, £150 a month can do, and how many years you'll shave off your mortgage term just by small overpayments like that.
Yeah.
I think just to circle back round to your point earlier about fixed versus tracker and taking a gamble, I think the most important point there is to only take the gamble if you can afford to do it. So yes, the rates look good at 3.74 versus 5.99. But if you couldn't afford another 2%, another 3% increase, and suddenly you're going to struggle to be paying the higher mortgage payments alongside higher energy bills, et cetera, then it will go a lot more into the camp of taking a fixed rate and taking that security, because it's all well and good taking the gamble, but if you can't afford to do it, then it's only going to hurt you in the long run,
I think you're right. From the bank's point of view, I'm a very cynical person, and I wonder why the banks are pricing things the way they are pricing things, with a very cynical view. Are you being goaded into the good deal? Maybe. And the other side of it, we've talked about it at length, is if interest rates for 5 and 10 year fixed are better than they are for a 2, which, like you said, is almost the wrong way round, does that mean the banks have a long-term view that interest rates will come back down? So there's a total conflict there. That are they goading you into a variable rate so you get charged high down the path, or are they encouraging you to fix for 10 years because it's going to go well? I'm not sure.
Yeah, really, really good point. And I think again, a piece of advice that I've given for as long as I can remember is that I don't think anyone will ever win by trying to predict interest rates or trying to time the market. No one's ever going to be right by doing that. The only thing that you can do is take the decision and take the type of rate that's right for you and your family at that point in time. But if you think that interest rates are going to go down in 2 years' time, but if they went up, you wouldn't be able to afford the mortgage, then gambling is not going to be the right thing to do for you. So even if you swear by everything that you own that interest rates are going to go down, there's no guarantee that you'll be right. So it always pays to make the decision that's right for you and your family. even irrespective of what you think is going to happen with interest rates in the future.
Yeah, I think that's really good advice, because you know, the last thing you want to be doing is taking that gamble on something you can't afford. And I think, like you said, Mike, if you do take that gamble, overpay so that you know what you're paying if it did go, you know, much higher. And even if you don't overpay, but you put it into a savings account, the difference, at least you've got that little bit of buffer. Or just go with the comfort of fixing in. You know, you can fix in for 10 years at about 5%, I saw there, which, you know, across the whole time I've been doing agency, 5% rates were probably somewhere around the norm, I would say. What advice would you give, Ellen, to people that are thinking about doing an upsize? You know, if we've got families that are thinking, do you know what, we've outgrown this, and regardless of what's going on here, there, or whatever, we've got another baby, we're working from home now, we need to make the move, we want to stay semi-local, and we're going to plan to upsize, so we're going to sell and buy. What would be the advice that you would give to them as it stands at the moment?
I think the thing to remember is the reason that they want to move and upsize is everyone has their own reasons. There will be other people in a similar boat. There'll be people looking to do the opposite and actually downsize and perhaps reduce the amount of their outgoings in monthly bills and that kind of thing, as well as first-time buyers still coming into the market. So I think it's more key now than ever, if you're selling, to get your pricing right, where I think there is more caution there from buyers regardless of their situation. So it's key to get the pricing right. And as we always say, you know, the house that they want to move to, someone may be looking to downsize from, and it's the age old, I want to move, but I can't see what I want to buy. If you all take the leap of faith and go on the market, then it kind of builds that, you know, builds that sort of circle of life, and everyone, you can start then seeing what's out there for people to move to and move from. But yeah, I think pricing is going to be very key, to make sure you've got enough interest from the right people.
Chris, we were talking last Thursday, and on Ellen's point there about pricing, we kind of suggested that prices are not the same today that are being agreed as they were 4 or 5 months ago. That you could deem that as a drop in the market from a price point of view. But actually, if we were to look at it across land registry over a 9-month window from, let's say, 5 months ago to 4 months' time, they would probably look quite similar. And actually, in summer, there was such little property available that there probably was some overpricing going on, and maybe, dare I say, some overpricing being agreed. And actually now we've kind of more plateaued to probably more where prices were around April sort of time. What kind of advice are you saying on valuations? Is it something along those lines, or are you kind of saying to people, set the seed with your price and pull the buyers in, or hold? What advice are you giving?
I'm just giving very brutally honest advice at the moment, as always, no matter what market we're in. But we're just not in a market where, you know, I do keep seeing it a lot of the time, and I won't make this into a rant, I promise, but you know, agents saying try X to achieve Y. If you think it's worth Y, then forget X, because that's where it needs to be. And it's, you know, it's very easy as agents for us to, you know, get a comparable report together. In fact, it's easy enough for anyone to do it. You know, the public can as well. Do your research before you have your valuations, but because you'll be looking at the same data that estate agents are. But I've had it on too many occasions, and you know, where I've gone out, done a valuation, I've given my price based on, for example, an identical house around the corner from another one, which sold at X. Agent X has got agent X, too many X's. Another agent's gone in and said this price way up here, but there's just nothing to justify it. And it does annoy me for the client, because, you know, I've got no issue saying to a client, look, if that's the figure you really truly believe it's worth, then go back to that agent, say, right, get me some viewings. Let's have some viewings. Let's see the result. If they get viewings, then they'll get offers. You know, but the chances are they probably won't. So my process of advice at the moment is the same as it's always been. And it's just a case of, look, this is the comparable evidence of what's selling. And what's not selling as well. It's not just about what's selling. You've got to show people what's not selling. If there's properties that are similar that are not selling, well, it's not rocket science. Our job is not rocket science. But at the moment, I think more so than ever, the daily reductions that we're all seeing on Rightmove and Zoopla and everything else, I think that's just reflective of the market just making an adjustment, or agents finally sort of giving the right advice, saying, okay, well, look, this was too much. We actually do need to be down here. And the penny's finally dropping, I think, for a lot of people, agents in particular. But there is still lots of overpricing going on. And, I'm not going to get involved with it. I just, I've got a lot of brilliant clients and who deserve my full attention. And there's little point me taking on something knowingly at a really inflated price, which is just not going to go anywhere, and it's not fair on everyone else that I'm working for. And it's quite an extreme situation for me to say no to something, but there have been instances where it's happened. So, so in a nutshell, just very, very brutally honest advice. Yeah,
brutally honest from Chris. And that you did well not to rant there as well. There was a lot of X's getting.
I nearly went. Yeah.
I appreciate
that.
Podcast. Tom, if you've got clients, and I'm sure you have, that are thinking about buying, so you're giving them, the advice at the moment, budgeting. If someone came to you and said, I'm planning a move for kind of April next year, around that sort of time, and I just want to get the lay of the land today, do you think the clever advice would be to bring that search forward 6 months? Because the chances are you're going to be looking at mortgage rates which are way more expensive than what they are now. Do you think maybe they'll be similar? I know you're not Mystic Meg, but we're going to call you Mystic Tom. What would you say to that buyer?
I think that it's widely predicted that interest rates are going to keep on increasing. There's a lot of articles published that the Bank of England base rate is going to hit 4, 5, 6% by this time next year. And by putting that search off by 6 months, you're potentially looking at a rate that's going to be 7, 8%. If you think they're high now, the Bank of England base rate is widely expected to keep on predicted to keep on increasing, I should say. So I don't think it's a bad idea to bring that search forward, to start looking to see what's available now, because if you're able to secure something now at 5%, and in 6 months' time it would have been 7%, then you saved yourself a heck of a lot of money over the term of that mortgage by just purely interest, by locking in a mortgage deal earlier than 6 months down the line.
Dare we say, Mike, today is the cheapest day to buy a property?
I was waiting for it.
We still haven't got the sign printed. I'm sorry. I feel
it's risky now. It's risky now.
Yesterday was the cheapest day to buy a house. Might become the strapline. I'm interested to know what the knock-on is of interest rate rises. Is it that people stop buying bigger houses, or is it that people reflect and look at what they're spending? So the amount of Range Rover Sports I see in my town compared to 10 years ago is absolutely phenomenal. There's Bentleys on the drives of normal 4-bedroom detached houses. It's absolutely amazing the amount of money people have had to spend over the last 10 years, and that's because people have been paying nothing on their mortgages. And will it mean that builders who have had an absolute bonanza over the last 10 years building extensions for people now get cancelled because people won't remortgage, pull 100 grand out of their house at 1.5% interest to add to their houses? So where do we think the knock-ons will be? That's my question. Do we think it will be in the housing market, or do we think it will be the kind of the sides of the housing market, like the extensions, like that kind of planning that get hit?
I mean,
for what it's for me. Sorry, Ian. No,
I was just going to say, from my point of view, just because I did a little video on this earlier, I think some of the things to remember from the economics of where we are in the UK, inflation obviously is high, but actually the rate of earning and the increase of salaries at the moment is outstripping inflation. So people are actually earning more money than, call it, around 10% of inflation. and the amount of money that's come into the economy because of furlough and because of the hosepipe effect of lockdown that stopped people spending money has meant that if you look around anywhere, even a Monday night, you know, at 5 o'clock, most good restaurants and pubs are packed on a Monday night, which is a little bit unheard of. And if you try and get a table at a half decent place on a Saturday afternoon at 3:30 when you'd expect it to be quiet, you won't. And I honestly think that if people need to move or want to move, they will still move. If people fancy the idea of it, but it's not quite affordable, they won't. And that's maybe where the market was a little bit ago. People panicked into thinking the market was getting away from them. So although they weren't quite ready, they did it anyway. I just don't think we'll see that. And that would be my take on it, is people are going to spend less money on cars, holidays, restaurants, Deliveroo, whatever it may be that they're burning, through their cash, and they'll make it work. And the numbers, Tom, I believe, with the base rate change recently, or if we saw 2% added, is it every percent of £100,000 is an extra £600 a month, or six grand a year? What's the numbers on it again?
Good question. 1% won't be an extra 600, but 1% will be some low multiple of hundreds. So it's still going to be affordable. It's not as if people are going to be out on the street. You're not talking an extra couple of £1,000 per month. And Mike, I 100% agree with your point, what you just said about cars. I think there'll be a heck of a lot of Range Rovers going back over the next 18 months. Because I agree with you, Ian, that if people want to move, they'll move. I think that the housing market in this country is relentless. We have a desire all within us to be homeowners and to move up to a bigger and bigger box to live in. So I do think that is people's number one priority. It'll keep on going, and just the luxuries will be cut back in order to be able to afford the necessities, shall we say.
Yeah, I agree. Melissa is asking us a quick question here. So she's in a shared ownership property, and the amount of increased rent she's paying for the share that she doesn't own through the housing association is going up, as they do after a 5-year window, or depending on the deal that they've got. She's already paying 4% due to it being shared ownership. And if they've got enough equity to move, is it advisable to make the move now and sell the shared ownership, or to stay put? Ellen, come to you first. We'll do a quick round on this, on our opinions. What do you reckon? What would you say to Melissa?
You have to look at why do you want to move? Is it, if it's because of the increased rent, what's it tangibly look like for you to sell and buy something at full price? What is the tangible difference in those two values? And I think that's what you need to consider. If it's about money for you, then look at it in black and white and actually see what that looks like before making a decision.
I actually spoke to someone that's thinking of selling a shared ownership today, and they've got a nice 2-bedroom semi-detached property. And the question is, if they bought a 1-bed house, or a smaller 2-bedroom terrace, or maybe even a 2-bed apartment that was their own, even with today's rates, they'd still end up better off than on the shared ownership. So I guess it depends on the circumstances. Are you looking to do a jump or a sideways, or maybe have a little bit less house but own your own? Chris, what do you reckon?
Yeah, I agree with both yourself and Ellen on that. But I think also, Melissa, I think self-stress test it in terms of obviously where the figures are likely to be. Look at you, do what the lenders will normally do, and that's, is it affordable for you, and what are you going to gain out of it? Is the uplift, because it's going to cost more money, obviously, is it going to be worth making that jump now? Is it affordable in the long term, whether you're going to be fixing in 2, 3, 5, 10 years, whatever it might be? And if it's justifiable to you to make that move, then yes, because in the long run, your property out of 100% owned property is your profit, your equity increase is going to be better. So yes, if it was me, and this is just me, this is not necessarily advice, but if it was affordable, I probably would.
I think the other thing on that as well, and Tom, I'll come to you next, but the other thing from an estate agency point of view, over the last 18 months, if Melissa was sold under offer and looking for a property, she probably, would have found it quite hard to get one, because unfortunately the pick of buyers basically meant anyone that was looking to buy a property would go proceedable, and if they went under offer, they potentially wouldn't go under offer on shared ownership. So she's actually probably got a better chance of getting the right property for her. Now there potentially will be a little bit more flexibility and less buyers in the market. That's the agency part of it. Tom, what about yourself? What's your thoughts on that? Obviously come to you, and you will have a conversation with her privately about the next mortgage, of course, but what other advice?
So I think shared ownership is great, first and foremost. I think it's a great stepping stone for people to get onto the housing ladder with the intention to move to 100% ownership later on down the line. I think the key thing is just to understand where you are now and where you could be if you move. So what's the payments now of the mortgage and the rent? What's the payments going to be for your mortgage if you move? What could you get for your money? You know, is it worth the upsize? If you could only do a sideways move from a 2-bed flat to a 2-bed flat, you know, is it worth it with the stamp duty and the fees? But if you can afford a decent upsize, it's going to be a bigger house for you and your family, then of course it's always worthwhile considering. And yeah, Melissa, if you do want to drop me a message when we come off the call, we can arrange a free call this week where we can look at some numbers for you. We can see what would be affordable going forward, what those monthly payments would look like, and you can just see if it would be worth a move or not.
Yeah, 100%. Definitely advise doing that. It'd be worth your time, Melissa. And thank you for your comment. Mike, any further thoughts on any of that? Or are you in agreement? Go and give us something controversial.
Well, I'll give you my broad swathing opinion on shared ownership, that I feel like it's a means to an end and not a permanent solution. So if your total payment is £1,000 now, and moving to 100% ownership property is within reach financially, and I think Chris said financially stress test yourself as if it's more expensive than it is, then I would do it personally, because I like Tom said, it's a great stepping stone, and that's his very politically correct, polite way of saying it's a bit of it feels like a means to an end. There'll always be something else next.
It's not long term, is it? Like, you don't want to be in shared ownership for the rest of your life. It's to get you to that next stage.
Yeah, I mean, you're paying someone, you know, a big percentage that you're not getting the equity back on. So absolutely. And we'll go around the room just quickly on this. So are we in a buyer's market now, or is it still a seller's market? And Ryan Bloomfield had the perfect answer for this on Thursday. I don't know if anyone saw it. Hopefully they won't copy. But what do we think? Mike, kicking off with you, buyer's market or seller's market, or both?
I think it's balancing, depending on what the property is. Let's be honest, every town has its different streets and its different demands. There's still roads where you know full well the minute that you list that property, it's going to go absolutely bonkers. And I know Dan and Neil have listed a house over the weekend and had 30-40 inquiries on it. So to that seller, it's very much still a seller's market, because they've got something that everybody wants.
Yep, love that. Sam's watching on YouTube. He or she has put a comment in. We will get back to you after the live chat on that, Sam. So yeah, we've seen your comment there, and thanks for putting it on there. Chris, what do you think? Buyers or sellers market?
Buyers market.
Buyers
I think
market.
at the moment. I think Mike is absolutely right. I think it's balancing, but I think it's more buyer's market at the moment, particularly where I am anyway, Camberley, Frimley. But then if you get a property on at the right price, as always, no matter what market you're in, it's going to go bananas anyway, isn't it?
Yeah,
so
yeah,
it's just quite
absolutely.
sensitive.
Ellen, any advance on that? Buyers, sellers?
I'd say we're slightly in favour of it being a buyer's market at the moment, but as the guys have said, it depends what you've got and how it's priced and marketed. You know, if it's desirable for a number of reasons, then it's going to sell for all those number of reasons, you know. So
yeah. Ryan Bloomfield said on Thursday, it's always a seller's market because the seller sets the price and the buyer wants something from the seller that has the ultimate decision on. So if the property is priced correctly, like we've all said, then it is the seller's market. They choose the selection of buyer, they choose the right offer and the buyer for them. But if it's priced incorrectly, then you're leaving it as a buyer's market. And I quite liked that, because I feel that's where we are at the moment. Like Chris has said, Mike said, Ellen said, if you price correctly, it will still go bonkers. And evidence of that last week. I mean, we had, multiple offers and over asking price stuff just last week, even though it was all sort of going a bit banzai. So yeah, it's on your terms, depending on, what you do with pricing. And I quite liked that. Tom, just before we kind of wrap up, what's your thoughts on valuations over the next month? What do you think's in the eyes of surveyors? Because they've been a little bit erratic this year, haven't they, from time to time, the surveyors? I don't want to irritate any of them out there, but feel free to give me a call if you need comps. What do you reckon?
The only thing I can say is I've done 2 purchase applications today, and both of them had an automated valuation. So they both sell through automated valuation. Lenders happy to rely on essentially a computer confirming the valuation. Lenders are still going to try and do that wherever possible. I've had probably not many down valuations this year. If I do get a down valuation, it tends to be on the ridiculous side, not on the little side. And let's just hope that the electronic valuations continue, because Lord knows that we love an electronic valuation. So let's hope that that continues.
It is one of the good things that did come out of COVID, was all of a sudden
100%.
lenders realised it's easier to just do that and have a bit of common sense. So yeah, appreciate that. Any last things from you, Mike, before we kind of bring it to a close this evening? Any little words of wisdom that you want to throw across?
No, I was just watching Ellen's face when they were talking about down valuations with a little bit of.
It's fine.
Helen loves surveyors. Chris, anything from you? Are you off to play the piano next?
Yeah, I'm going to give it a go in a minute.
Yeah.
No, nothing really further for me at the moment. I just think it's going to be watch this space for the coming weeks. And the message I put across to people is that just don't, as far as our industry goes, I appreciate most industries are going to suffer one way or another. Don't panic. Don't panic. It can work out.
Don't panic.
Just quickly on those comments, Sam, who's just commented again, the property that I was referring to that got 30 or 40 inquiries over 24-hour period is the one you've inquired on. Dan and Neil are working through those inquiries. They will be with you, I promise.
Yeah, there's quite a lot on that one. Yeah, I would pass quite a few over. And Ellen, kind of your thoughts in the Bracknell market. You're expecting it to stay pretty active. I mean, Bracknell never really shuts off, does it? So
no, it's one of those places where people will always be moving. They go from the 2-bed to the 3-bed to the 4-bed consecutively. So I think, as Chris said, don't panic. People still need and want to move. And will. So yeah, just give us a shout. We can talk you through it, because your situation is going to be so unique. So
yeah, no, I appreciate that. Tom, it's been awesome having you on. We're obviously back on next Thursday at 6. If anyone's got questions and want to watch what happens in the next couple of days, then if people want to get in contact with you though, what's the best way to give you a shout, Tom?
So we'll drop our contact details in the comment of this live. Our website is partnersfs.co.uk. Contact details will be in there. You can call or email. All our contact details will be on the website. We'll also put it in the comments below. I also do have one more point to make just quickly. I know that we've been 43 minutes and we are getting a bit long, but just one quick point, as a lot of people I know watching this will be home owners already that are coming to the end of their fixed deal in 2023 and just a little bit concerned about their mortgage rates rising. So the point I've got to make is, if you've got a fixed rate that's coming up for renewal any time up until the 30th of June next year, you can secure your fixed rate now. So any date up until the 30th of June, you can secure your fixed rate. If the rates go up, it doesn't matter, you've already secured it. If the rates go down, you can change onto the lower rate at any time before you complete. So just something to think about. I know a lot of people are worried about the mortgage cost potentially being a little bit higher when they reach the end of the fixed rate. But yeah, any time up until the 30th of June, you can now secure a new deal.
That's something really everyone in the UK should take advantage of if you've got a mortgage, I would say, that's coming up to that fixed term. So yeah, great tip to end the show on. Chris, Ellen, Mike, Tom, thanks for joining us on a Monday. If anyone's got any questions and we're not live, still throw them in the comments. We will respond. Or obviously follow us on the socials, drop us DMs. And like I said, if you want to get in contact with Tom, jump on the website or their Facebook page and get in contact with them. So have a good week, everyone. And thanks for joining us. And thanks for the questions and the comments from everyone.
Thanks, guys. Nice to see you all.
Bye.